So let me be real with you. Negative gearing is sold like it's this free gift from the government. Politicians hype it, spruikers act like it's free money, and everyone says the exact same thing. Don't worry if you're losing money, you'll get it back at tax time. But here's the truth. That kind of mentality is complete nonsense. At the end of the day, you're bleeding cash every single week just to save a tiny bit on tax. And that exact mindset tricks people into buying assets that never actually build their wealth. I've seen too many investors stretch themselves thin, thinking that they're being clever, only to realize years later that they've been gambling with debt the whole time. And that's exactly why I'm making this video, to show you why negative gearing doesn't actually help most people, who benefits from it, and most importantly, what smarter plays there are out there that you could be employing today. And trust me, you're gonna wanna stay right until the very end, because the winners and losers from negative gearing, well, they're definitely not you and me, and they're not who you think either. Guys, my name's Josh, I'm from DataEdge Property, and I help everyday Australians navigate the Australian property market using data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you smash that like button. And with that said, let's jump straight into what negative gearing actually is. So at its most basic level, negative gearing is when you borrow money to invest into an income producing asset such as property, and the cash flow on that asset results in a loss. So that loss can be deductible against your personal income. So to give you a really basic example, if you own a property and the rental income on it was, let's say, $10,000, but all of the expenses associated with owning that property were $20,000, so you made a $10,000 loss, well, that $10,000 loss is deductible against your normal income. So let's say you work a normal job and that job pays you $100,000 in a year. Well, that $10,000 loss, you can deduct that or use it as a tax deduction against your gross income. So in the tax office's eyes, you'd only be making $90,000 and only paying tax on that $90,000 income. And as a result, you can actually reduce your tax bill. Now, a lot of people talk about negative gearing as if it's a strategy, which I would never call it that. But what you need to know is that negative gearing only makes sense if the capital growth on the asset that you're investing into outweighs the cash flow losses that you're making on it. Now, whilst negative gearing might sound clever on paper, the maths, well, it often doesn't stack up. And in a minute, I'm gonna show you why that so-called tax refund isn't the win that most people think it is. And here's a quick question for you guys. Do you think that negative gearing is actually a smart play or just a tax outcome? Make sure you drop your answer in the comment section down below. I'm really curious to hear what you think. So why do I call negative gearing a scam? Well, at the end of the day, you're still losing money. You're spending, let's say, tens of thousands of dollars a year on an investment property just to get back 3 to 4K from the tax office. And as a result of that, it can end up actually locking people into weak assets. Things like high-rise apartments or really poor yielding stock. And on top of that, it assumes endless growth. And we know that although the Australian property market across the very long term tends to perform at 6 to 6.5% per annum, looking at historical performance, those growth rates can vary wildly between state to state and depending on what type of cycle we're in at a given point of time. So for example, between 2002 and 2012, the Sydney property market, well, it barely moved. And imagine you were holding at that time a poor yielding, let's say 2.7% yield property, whilst you weren't getting any capital growth at all on it. Well, you'd have a massive cash flow hole in your pocket. And let's say during that time, interest rates got tighter and it became incredibly difficult to hold onto that asset. Well, all of a sudden, negative gearing isn't gonna actually help you. It might help potentially soften the blow, but really you've gone from losing money to losing slightly less money. And the last reason why I tend to call it a scam is because politicians love it because it props up demand on often weak cash flow assets that otherwise wouldn't be attractive to investors. And the reason it even existed in the first place was to incentivize investors to provide rental properties into the market. So that's the only reason the government even has an interest in it in the first place. But here's the kicker. The people who actually benefit from negative gearing, well, they're not the people who you actually think they are. And here's the part that most people forget. Negative gearing, it's not even guaranteed to stay around. Remember when Labor tried to scrap it a few years back? Well, that type of debate, it's almost guaranteed to come back at some point. And if it does, investors who are banking on those tax breaks could find themselves stranded. Imagine losing money on an asset and the tax break that you've been relying on the whole time to make that investment looks okay just gets removed from you entirely. It would be a complete disaster. So with that said, who actually benefits from negative gearing? Well, firstly, it's high income earners. And when I say high income earners, I mean the top 5% of income earners. Those who can actually weather those material cash flow losses without having to sell an asset. I don't know about you, but if I was losing 60K a year on a $3 million investment property in Sydney, well, I probably wouldn't be able to hold onto that asset for too much longer. It's those high income earners that can absorb those losses and benefit from a materially reduced tax bill. Secondly, it's politicians and lobbyists because they absolutely love the demand that it props up in the market and pushes prices even higher. And as a result, governments make more money off stamp duty and generally land tax and all the other taxes we pay on property ownership in Australia. Thirdly, it's developers and marketers because all of a sudden they can sell properties that wouldn't be attractive at all to investors on the basis that they're going to reduce their tax bill. And lastly, it's everyday investors because they're the ones who are actually footing the bill. And this is why I always say, I'd never buy a property just for the tax benefits. The fundamentals actually need to stack up. And if you're not sure how to analyze a deal, make sure you grab my completely free property due diligence checklist in the description box down below. It's the exact framework that I use to filter out bad assets. And while we're on the topic of bad policy, make sure you check out my video on the 5% government deposit scheme for first home buyers. Just like negative gearing, it's sold as a helping hand from the government, but in reality, it could actually add fuel to the housing crisis. If you're interested, check that one out in the description box down below. So with that said, what actually happens if you build an entire portfolio around negative gearing? Well, you could be exposed to a number of hidden dangers. Firstly, you might suffer from material cash flow drain. Whilst one negatively geared property where you're losing, let's say 10 to 20K, that might be manageable, but owning 2, 3, 4, or 5 negatively geared properties, those losses can mount and they can mount exponentially. I mean, the average person, they simply aren't able to weather hundreds of thousands of dollars of cash flow losses. Secondly, there's equity risk. So when you're purchasing a negatively geared property, you're relying on the value of that property to increase over time. And if it doesn't, and all of a sudden you have to sell that property into a market, let's say you lose your job or your situation changes, well, if that property hasn't gone up in value in the time that you've been holding it, not only have you mounted cash flow losses, but now you might be selling a property at a capital loss because you've had to pay for things like stamp duty and perhaps the market's even dipped backwards a little bit. So that equity risk is a genuine risk. And the last hidden danger is that false security. People think that the ATO is helping them, but really you're bleeding cash throughout the year just to get a small refund from the government. So if negative gearing is bleeding cash, what are some strategies that I would be focusing on instead? And guys, if you disagree and you swear by negative gearing and it's completely worked for you, I want to hear your story. So make sure you leave it in the comment section down below. So with that said, what are some potentially smarter plays that I would be considering if I was investing in the markets today? Well, I'd prioritize strong, growth-orientated assets with a balanced yield. If I do my calculations on a property and I know it's going to cost me an X amount of dollars to hold, well, I'd be seeking a yield that is going to at least cover those costs, if not make me money. But I don't just mean focusing on high yielding properties and that's it. I'd want to be entering into markets where there's a misbalance between supply and demand so that I can get capital growth at the same time. And it's purely a myth that you can't achieve both capital growth and a strong yield at the same time. I always focus on suburbs that have real demand drivers, things like jobs, infrastructure growth, population growth, and other metrics that I know drive capital growth. And there's over 30 of them, but things like days on market, stock on market, vacancy rates, etc. But remember, I'm just a random guy on the internet. I don't know your individual circumstances, and you should definitely get qualified, independent financial advice before making any investment decision. Now, if this kind of breakdown helps you, make sure you hit the like button. It helps other Australians see data-driven content just like this. And don't forget to subscribe so you can see more property insights like this in the near future. So guys, with that said, negative gearing, it certainly isn't a strategy. At best, it's a band-aid for a bad investment. Personally, I never buy weak assets just to chase a tax refund. I prioritize building a portfolio that pays me back in terms of both cash flow, but also capital growth. If you've made it this far, thanks so much for staying until the very end. My goal is to cut through the noise and give you insights that actually help you in the future. If you got value from this video, make sure you smash that like button. It really helps more people see content just like this. And again, grab my completely free property due diligence checklist in the description box down below. Guys, I hope you enjoyed the video and I'll see you in the next one.